Welcome, you're watching NDTV Profit, and it's the run-up to Diwali, Profit Wali Diwali like we're calling it. The markets, of course, supporting that sentiment on the street today. All eyes will be in the festive season, and it is Dhanteras tomorrow. So keeping that in mind, we decided to make this show a special one where we'll tell you whether or not you should be adding and how much should you be adding gold to your financial portfolio. Well, over the next 20 minutes, I will try and assess whether or not gold looks like an asset class that one should aggressively invest in, or should it be just cultural in that sense. Joining me on the show are going to be Chirag Mehta, CIO of Quantum AMC, and Chintan Mehta, CEO of Abans Holdings. Thank you, gentlemen, for joining us today on the show. Chirag, I'm going to start with you first. It is the mood for festivities. It's Dhanteras tomorrow. We all know as Indians, we will all want to go out and buy that one sikka of gold, if nothing else. But gold has become even more significant, especially after the run-up that gold has seen this year. It's done better than equity markets, to say the least. What are your thoughts on gold? And then, of course, we'll elaborate on how one should use gold to add or structure one's strategic long-term portfolio.
Absolutely. We have been natural buyers of gold, but the trends are changing in terms of not buying a sikka, but buying a gold fund. So we are seeing that change in trends. And when it comes to this year, I think it should be bought into. Because if you see the rally that we've seen in gold so far has been fundamentally backed. And we see no reason why many of those fundamental factors should not lead to more support for prices going ahead. So if you see what has led to the gold price is, one is, of course, geopolitical tensions, but speaking more fundamentally, it is related to the change in interest rate cycle that we are seeing currently. So as we see the real interest rate stabilize or go down from here on, gold generally does well in those time periods. There have been some headwinds for gold last year when you saw that interest rates were moving high and staying high for a longer time. Despite that, geopolitical tensions were supportive, and hence gold kind of stayed where it was. And this year, when we see more indications of interest rates cuts coming, we have seen gold prices move up. So we think that we are in a rate cutting cycle, which is going to be extended into the next year. And hence, gold will get support because of that. Second is, there has been a lot of central bank buying because there is losing confidence in the dollar to some extent. And if you see the share of reserves that central banks hold, the dollar share is coming down. It was about 72% a few years back. It's come down to 58% now. So, and where are they going? Given there are not many alternatives available which can absorb that much liquidity, it is going into gold. So, lack of alternatives to move away from the dollar is also leading a bid in gold from these central banks. We don't see these trends changing, even in light of the dollar strength that we have seen recently from 100 to 104, 105, and also yields, strengthening from 360 to around 410, 420. Still, we have seen that gold is doing better. So from all these perspectives, I think there will be a support for gold prices going ahead. And probably the past bull runs that we have seen in gold, this increase hasn't been as significant or as high as what we have seen previously. Most bull markets have seen around, say, 4 to 5x increase in prices. This time it's just doubled in price from the lows of 2016 that we have seen. So overall, I think there are still more fundamental factors backing this price move, and I don't see them going away in a hurry.
Right. We also have with us Chintan Mehta, who joins in. Chintan, we talk about gold at least once a year during this time, right? Just before Dhanteras, everyone is talking about gold and the outlook of gold. But the fact remains, as we've talked about it this year a lot more than we've done historically, largely because of the kind of performance that we've seen on gold prices. How do you feel about gold? Do you feel the outlook still looks very constructive? And I know while it has an important role in a strategic portfolio, tactically as well, is gold a good buy?
Gold, I see always a good buy. Over a period, if you see, that's what I was even telling one of our friend also. If you see from last 15 years, gold has gone up from 12,000 to 80,000 rupees, especially in Indian terms with the currency depreciation and the kind of geopolitical tensions going around in the Middle East. Plus, if you see fundamental change, what is happening is a currency crisis. Initially, what used to happen is USD was a king, but slowly, if you see, there are a lot of shifts from this. So ultimately, we have to decide what is the next reserve currency it can be. So gold and the Bitcoin are the two major component we can think, but gold has a larger history, proven history, a track record from a very long point of time. So I see gold in a current situation as a great buy, and it's in a good bull run. But once again, it has rallied from the lows of 2200 to 2700 in a like no time. So it might take a little breather here, but in a long term, it is still a very, very good buy, and everybody have to have a chunk of gold in that portfolio. And I would say sizing should be sizable, not like before where we just have to be like 4 to 5% on only our portfolio.
Right. Chirag, it's very tempting, as a woman at least, to go out there and buy gold jewelry instead of putting that money in a gold mutual fund or an SGP, right? But tell me, physical gold still qualifies as a strategic financial investment?
It does qualify as a strategic financial investment. Only problem with that is it's very inefficient. If you buy physical gold in any form, there are making charges associated with it. There are concerns on purity. There is storage and the chance of a theft that happens. So all those issues go away with when you buy gold in a gold fund or a gold saving fund. I mean, an ETF and a saving fund, because you don't have to worry about purity. It's guaranteed. The kind of gold bars that we buy, it's 100% backed by gold. It's 24 karat gold again, which Indians like. And we stored in professional vaults and it's completely insured. So from that perspective, I think it's time that we differentiate between what is there for consumption and what is for investment. We wouldn't count anything left for consumption as an investment for you from a portfolio standpoint. So you can leave that aside, and anything that you want to buy for, investment has to be in form of which are very, very price efficient. In a gold ETF, you are buying gold at prices where tons and tons of gold get exchanged between a gold producer and a bullion bank. That is the efficiency that gold ETFs bring from a very wholesale level to a retail level. And we have seen in a gold market, right? The lower the denomination you go, the higher the premium you need to pay. Whereas in a gold ETF, even you're buying 0.01 grams of gold, which is virtually not possible if you go and visit a jewelry store or a store that sends coins and bars. Minimum you have to buy 1 gram. And the lower the denomination you go, the higher the premium you pay, which is not the case with gold ETF. Even you buy 0.01 grams of gold or you buy 1 kg of gold, you get the very wholesale prices when you buy it. So from all these standpoint, it's a really hands down winner when it comes to gold ETFs and gold fund. And I think gone are the days when those choices were not available and people were forced to buy physical. I think today we have plethora of choices which are very, very efficient, and hence you should go into those.
And I know with Quantum AMC, of course, is more than just a gold fund, right? You've got a multi-asset fund of funds. You've got some gold fund, the gold savings fund, and I'll talk to you about all of that, Chirag, in a minute. Chintan, how much % of one's portfolio should be allocated to gold? And I'm talking with somebody who's average age with an average risk profile, but the bias is to equities for wealth creation.
I think in a current situation, your portfolio allocation should be in a gold should not be less than 15 to 20%, depends upon what exactly the financial arrangement one has made, because gold has been given a good return, which was not the case initially, and it is a hedge against the other investment like equity, real estate. In case of difficult years, gold will outperform, and on a normal years also, with the kind of situation we are into, which is a downward interest rate, and the real interest rates are going to be for a gold would be positive, So 20% is my punt, it's minimum, and I always have loved gold. And if you see the returns over a period of time in equity index, if I see, it's around 13% per annum since inception, and gold would be somewhere around 8 to 10%. But the kind of comfort and the kind of the solidity which it gives it's tremendous. So I would say minimum 20% investment for the middle age and the medium income size.
Chirag, what are your thoughts on that? What percentage of one's portfolio should be allocated to gold? And also, do you recommend this to be done through an SIP, or should this be done upfronted or in lump sum investments?
So we have done some studies in terms of the more you add gold to your portfolio, what is the impact on returns and risk reduction that gold tends to bring. So we kind of added 5% to the portfolio, and about at 15% allocation, you don't impact overall portfolio returns. It just got augmented to some extent. And the risk reduction keeps happening with every 5% addition. So 15% is that sweet spot where you kind of add to portfolio returns and still reduce the risk of the portfolio by adding gold. Beyond 15%, it does reduce your risk, but you start compromising on the return potential of your overall portfolio. So 15% is that optimal level where you kind of balance out the benefits of adding gold from a risk return perspective.
So Chirag, in a case where somebody doesn't have any gold as part of their financial portfolio currently, what do you recommend he should do? Should he buy the 15% upfront, or should that the entry be staggered? Because we have seen gold up 33% year to date, right?
So I think, as I said, fundamentally, it looks good from a medium to long-term perspective. Short term, yes, there could be anybody's guess where the gold price are headed. Of course, it has moved higher, but we have seen those cycles, right? From 2002-3 to 2007, how gold moved up, and there was a brief correction in between, and then again it moved up. So you will see those cycles in gold, and this cycle looks favorable. So if you don't have any allocation to gold, maybe I would say that if you, assuming you want to reach that 15% goal, maybe buy half of it now and half of it stagger over next 12 months would be an optimal strategy that you should adopt.
Chintan, what about you? What do you recommend to your clients? What is a preferred instrument to invest in gold?
See, I think Chirag has spoken very nicely that whatever is there to consume, I think physical is the natural choice, and with the kind of demography of our population, every year marriages are going to be on a top of the list, whereas female have to wear the ornaments or have to consume gold. That is where the physical gold comes into play. And that is why we see that even though we import on an average somewhere around 800 tons of gold every year, but AUM in gold ETFs are not more than 60 tons, only 60 tons. Whereas in a globally where people are not consuming gold, it is still at 3,000 tons. So there is a long way to go. People are still believing in physical, but yes, trend has to change. And investment product, whatever our clients have to make, we always suggest them as an ETF. ETF is a wonderful product where you can marginize it also. So if somebody is playing a derivatives, then he can also pledge these units and get the margin. So as per my understanding, whoever wants to levered return, they can maximize the return by leveraging it through ETFs and fund of fund or the multi-asset fund. Okay, so whatever is there for the consumption, you please buy it in physical. Otherwise, paper products are the best products.
Paper products, the best products, and then begins the debate. ETFs, SGBs, Chirag, or pure and simple active funds. Where is your bias? Or all of them? That's an open question, by the way.
So I think in today's parlance, gold ETFs are one of the best instruments. I explained most of the reason because it's one of the very price efficient products available, and gold funds are just a wrapper around the gold ETF. So they are mostly the same. They will have similar returns over a period of time. When it comes to choice between this and SGBs, so today we don't have any tranches for SGBs coming out, so it's difficult to buy. You need to go onto the exchange, find that liquidity. Today we have also seen instances of it trading at a premium. So the interest benefit that you get, to some extent, it gets washed away because of the premium you end up paying. Plus, to get the tax benefit, you have to hold till maturity. Say tomorrow, if gold prices were to go to $3,500, $4,000, and if you want to say book your profits or rebalance your portfolio, which will be very, very difficult in those times when there will be more sellers as opposed to buyers at that point in time. And we don't know if the premium that you will pay, it will continue to pay, trade at that premium, or it comes to a discount. So there are a lot of uncertainties now with the SGBs overall in terms of buying, selling, etc., which kind of leads to uncertainty on the benefits that it provides. And hence, today, there is no match to gold ETFs, gold funds, given the liquidity it has, given the gold backing it has, given the convenience it has. It's virtually available by 24/7. Even in the COVID lockdowns, this was the only product that was available 24/7 virtually, as opposed to even the shops that were closed at that point in time. So given that all these benefits that it brings to the table, I think it's a clear winner for me.
Chintan, do you feel like gold and silver are interchangeable and silver is a good proxy to gold? So if not gold, can somebody look at adding silver to their portfolio?
No, big no. This is, I would not like to go away with the common contention people what make is silver can run away and it can replace gold as a portfolio to make a better return, because silver in a span it might run very high than the gold. But if you see in a long run, so I was just giving a stat to someone, if you go to somewhere around 2010, silver was available at 25,000 rupees per kilo and gold was available at somewhere around 12,000 rupees per 10 grams. Right now it is at 80,000 rupees per 10 gram for gold, and it is just the 4 times in silver. Plus gold is a perfect hedge. It acts like a currency in case of any global disruption, any risk to the currency or the war zones, whereas silver acts like a more of an industrial metal. When something goes wrong, it is the one which goes down terribly. If you see the COVID, if you see the Lehman Brothers, and it doesn't give you that base where you can depend upon the return, what you can depend upon the gold. Gold is like an elephant. It just doesn't move like that. The volatility of silver is somewhere around 22, whereas gold is around 10. So it's very solid, plus it is giving returns. So what's the point shifting it to silver?
It plays a role of adding stability to the portfolio, so you don't want to take that away. I want to talk about another angle, Chirag, and it's always good to be completely mindful and aware of the asset class and the instrument you're going into, right? So talk to us about taxation. Is gold taxed in the same way as equities, whether it's short-term and long-term? Capital gains, if any, and any sort of exit, entry loads that one should be aware of before making that investment into gold through a mutual fund route?
Sure. So when it comes to gold ETFs, they are taxed up to 1 year based on your marginal tax rate. And above 1 year, it is exactly in line with equities at 12.5%. When it comes to the gold fund of funds or gold saving funds, as they are called, up to 2 years, it's taxed as per your tax slab. And after 2 years, again, it's in line with the equity taxation rate, which is 12.5%. So I would generally presume that anyone has at least 1 or 2 years of horizon minimum to add these asset classes in their portfolio. And having said that, if that is the case, then probably it doesn't matter which instrument you go into, because both are very, very similar from a return perspective, but only taxation difference is that you have to wait for 2 years in a gold saving fund, whereas you have to wait for 1 year up to for the gold ETFs. So taxation has been rationalized now. So this creates one more incentive for investors to look at these efficient products.
Chintan, in your opinion, because of course you don't represent a single instrument in that sense, where do you think, or where is your bias? So when you recommend to your clients to go out and invest in gold, what is your preferred route of investments, keeping in mind taxation, cost, and everything else?
We always recommend depend upon the investor's profile, but this is a very generic question because it has come now. So if somebody wants a mix of it, then the multi-asset funds are the good asset, because there the portfolio manager can decide about what percentage they wanted to invest into gold or equity or fixed income. Because every asset class of the capital market gives at different time a different kind of return. So if somebody is in the current horizon, where gold has already rallied, but fixed income is still keeping it long, I would suggest in a multi-asset fund, investor means portfolio manager would put his weightage on the GSEC more. because it also comes with a capital gain. So interest rate is inversely related with the GSEC price. So if interest rate starts going down, I think with a levered return what GSEC can generate, a fixed income can generate, will outperform equity as well as gold. So my point would be on a multi-asset funds rather than just straight away investing into gold, because it's just the one asset class. If you trust the fund house and the portfolio manager with their past track record, I think multi-asset funds are the better choice right now.
Multi-asset fund. Chirag, you want to come in on this one because you do have an ETF and a fund, and you also have a multi-asset fund of fund. If you had an investor who asked you, without any biases, what should they be looking to do, and somebody who's got an average risk profile in that sense, what would you recommend? Where should be the starting point for an early investor?
It's very, very clear, right? If you are choosing, say, multi-assets, a one-stop solution for any investor's need of investing. So you are outsourcing the entire asset allocation to the fund manager. So if you're doing that, then that's good. Then that takes care of your all the asset classes investment and tactically changing it over time as you get opportunities in each of the asset classes. But when it comes to, and this is most investors end up making as a mistake, is you allocate 20%, for example, to a multi-asset fund and do other allocation on your own. In that case, if you have 20% allocation to the multi-asset fund and the fund manager has 10% allocation to gold, then you end up having only 2% allocation to gold on an entire portfolio, as opposed to what is desirable is 10 to 15%. So you need to choose between how you are approaching your investments. If you're outsourcing entirely to the multi-asset fund, which is well and good, then that's completely fine. But if you do a mix of the two, where you take a multi-asset fund and then allocate something on your own, then probably you need to be mindful of the allocations you end up getting.
Then in Chirag, we have a few minutes to go before we have to, of course, run out of time. But let's take a few queries, and it'd be nice to have, investors or viewers actually ask both of you about their questions. Kashish writes in. Kashish is 25 years. Kashish's goal is she would like to set an SIP of 5,000 and needs fund recommendations for the same. I'll have you go for it because Chirag, you've been tracking this quite closely. I mean, it of course gives a broader perspective.
Yes, I think 5,000 rupees SIP, I think 3,000 one can go with the large cap fund or the index fund, and 2,000 we can just allocate towards a small cap fund. Whereas average return, what we can expect would be somewhere around 17 to 18% CAGR, which I think it's a very, very great size when you enlarge the period, compounding, I always say that it is the eighth wonder of the world. It looks pretty small, but when you expand the horizon or expand the time zone, it really gives you around, amazing return. So 3,000 toward large cap or the index fund and 2,000 toward the small cap, because India is a perfect place to invest right now.
Right, I agree. The power of compounding is what we talk about often. It's not timing the market, but time in the markets, which is very commonly said. The next question comes in from Kaustubh. Kaustubh is 34. Kaustubh is looking for a recommendation. He has about 30,000 SIP in a gold ETF. Is it a good idea to diversify into silver ETFs as well? Chintan, Chirag, you want to have a go at this one? We've already talked to Chintan about silver. It'd be good to know what you're thinking about silver right now too.
Yeah, absolutely. So if you see, a lot of people call it poor cousins, gold's poor cousin, right? We think that it is half copper, half gold. Well, like Chintan said before, if you look at, it's an industrial commodity. 65% of the use of silver comes from industrial uses. And it behaves more towards giving you exposure towards growth in the economy per se, because industrial metals will do well when there is growth in the economy. And that's a similar exposure you end up getting with equities. So if you have a good equity portfolio, no point diversifying. It won't give you a diversification that you're looking for. Gold at the other end does help you diversify. And there are many stories that we hear about silver, right? That, their demand will go through the roof. Today, everything green uses silver. But as history has taught me that, the commodity remains viable till its price remains viable. And when its price starts crossing a limit, the usage of it becomes unviable, and there will be technological advancements and substitution that will take place, which will reduce the demand. And what you thought that's going to be a bull story for that metal, it ends up going the other way. For example, silver is used in solar panels. So the silver paste is used in solar panels. And if you look at a new technology that has come in, reduces the use of silver in solar panels by 30% immediately. So if that kind of things happen, what you thought was a great demand driver really fizzles out, and it leads to not what you expected. So I think gold is a better place to be if the investor is allocated to gold. I think that's kind of warrants a he's done a good job in terms of getting allocation to the right place. I think venturing out to silver is comes with, it's like a double-edged sword. It has its own volatility on the upside as well as downside. So I think gold from a portfolio standpoint is a good place to be. Silver, if you understand the demand supply dynamics, and if you can understand that, time it in terms of entry and exit, then probably you could go for it. Otherwise, gold is better.
And what better time than now to buy gold, given what's happening globally and the fact that we're celebrating Dhanteras tomorrow. Please go out and buy gold. While you might want to buy the sikka, the better way to do this could be to buy paper gold. But hey, who's stopping you? Get both. With that, we're completely out of time. Chintan, Chirag, thank you for your time. Happy Diwali, happy Dhanteras, and may this be a good year for both of you. Thank you very much. With that, completely out of time on this edition of the Mutual Fund Show. Thanks for watching.